In our last video, we covered the Vanguard and iShares asset allocation ETFs as if they were the only two asset allocation funds around. The truth is, if you're really comparing notes about one-ticket funds, BMO's asset allocation ETFs deserve your attention as well. Seriously. The only reason you probably don't hear about BMO as often as Vanguard or iShares is because, well, investors just don't ask us about them as often. Today, let's turn this popularity contest into a proper review. To keep things simple, we'll compare BMO's asset allocation ETFs to the iShares Core ETF portfolios. We'll skip Vanguard today for several reasons. First, the BMO and iShares portfolios share the most in common, offering the best apples-to-apples comparison. Second, your screen would start getting too crowded if I tried to display all three. And third, to get the full picture, you now have a great reason to revisit our last video comparing Vanguard and iShares. Unlike iShares, which has 5 asset allocation ETFs to choose from, BMO has so far launched only 3, with options for 40%, 60%, and 80% stock allocations. 2 fewer funds is likely not a deal breaker for most investors, as the most popular asset allocation ETFs tend to be the balanced and the growth portfolios. Each of BMO's 3 funds includes several underlying ETFs, which invest in thousands of individual stocks and bonds, providing Canadian investors with extensive global diversification. BMO's product fees are also comparable to the iShares portfolios, with MERs of 0.2%. If there's one obvious difference between the BMO and iShares asset allocation ETFs, it's that BMO excludes small-cap foreign stocks in their funds, while the iShares portfolios include them. In fact, the iShares portfolios include more than 6,000 additional stocks. You might think having more small-cap stock exposure is better, but since the indexes tracked by both the BMO and iShares portfolios are market cap weighted, larger companies will take up most of the weight in your portfolio anyway. The performance of these bigger companies will have significantly more impact on your risk and returns than the thousands of smaller companies excluded from the BMO funds. These smaller companies make up only around 10 to 20% of the US, international, and emerging markets equity ETFs found in the iShares portfolios. If this is still a sticking point for you, let's check out the historical performance of an all-equity index portfolio containing small-cap foreign stocks versus another portfolio with no small-cap foreign companies. Over the past 25 years, ending December 2019, both portfolios had an annualized return of 8.2%, and both portfolios had similar risk, with standard deviations of 11.7%. If we plot this data in a graph showing the growth of $10,000 over this period, we find that the blue and gray lines are almost identical. In other words, whether or not your asset allocation ETF includes thousands of additional small-cap companies is not a decision worth agonizing over. Your investment returns are mostly going to be determined by the performance of the larger companies within the portfolio. Now let's talk foreign versus domestic details. Similar to iShares, BMO has allocated 25% of its equity mix to Canadian stocks and 25% to international developed market stocks. US stocks receive another 40 to 41.25% weighting in BMO's portfolios, which is slightly lower than the 45% US stock allocation found in the iShares portfolios. Emerging market stocks make up the rest of the pie. BMO allocates between 10% and 8.75% to these developing markets, while iShares allocates just 5%. You'll notice that iShares significantly underweights emerging markets and overweights the US stock market relative to BMO. So all else equal, if you prefer more emerging market stocks in your portfolio, BMO is the way to go. Some astute investors may have already noticed that the BMO asset allocation ETFs hold a more tax-efficient emerging markets equity ETF than its iShares counterpart. Specifically, it holds the BMO MSCI Emerging Markets Index ETF with ticker symbol ZEM. ZEM holds most of its underlying stocks directly, resulting in one less layer of unrecoverable foreign withholding taxes across all account types. In comparison, the emerging markets equity holding in the iShares portfolios will have an additional layer of tax drag. However, ZEM's structure generates other indirect costs. So while ZEM's structure is arguably the most tax efficient on withholding taxes, that doesn't mean it's the optimal structure when all costs are considered. In the past, it has struggled to closely track its index, offsetting most of the benefits from its more tax-efficient structure. For this reason, and because the allocation to emerging markets is relatively modest in both portfolios, I don't see ZEM's increased tax efficiency as a make-or-break reason to favor BMO's ETFs over the iShares. Within the portfolio's fixed income allocations, BMO targets 90% Canadian and 10% foreign bonds, but that foreign allocation is made up entirely of US midterm investment-grade corporate bonds. BMO also hedges away the foreign bonds' currency risk, which makes them behave more like Canadian bonds. In comparison, iShares targets 80% Canadian and 20% US bonds in their portfolios, split evenly between government and corporate investment-grade issues. Like BMO, iShares also hedges away the foreign currency risk. The BMO bond portfolios have a couple of other characteristics of note. First, their government bond allocation is slightly higher compared to the iShares portfolios, around 72% versus 68%. Second, BMO's bond portfolio has a higher average maturity and duration than the iShares bond portfolio, so it's expected to be more sensitive to changes in interest rates. The higher duration may make BMO's bond portfolio a bit more volatile, but the extra helping of government bonds also decreases the credit risk. So the BMO portfolios may be right up your alley if you'd prefer more stable government bonds in your portfolio. And last but not least, when it comes to rebalancing, both BMO and iShares will take care of this for you. BMO plans to review their portfolios quarterly and rebalance any fund that has drifted by more or less than 2.5 percentage points from its target weight. For example, the BMO Balanced ETF, with ticker symbol ZBAL, has a Canadian equities target weight of 15%, invested in the BMO S&P TSX Capped Composite Index ETF, with ticker symbol ZCN. So BMO would likely spring into rebalancing action if ZCN were to become more than 17.5% of the portfolio, that is 15% plus 2.5%, or less than 12.5%, or 15% minus 2.5%. In practice, BMO will typically use new cash flows to top up any underweight asset classes. This should reduce the need to rebalance by selling securities at a gain, which could be taxable to the ETF's unit holders. iShares plans to rebalance anytime an asset class drifts off target by 10% in either direction. For example, the iShares Core Balanced ETF portfolio, with ticker symbol XBAL, has a Canadian equities target of 15%, invested in the iShares Core S&P TSX Capped Composite Index ETF, with ticker symbol XIC. If XIC became more than 16.5% of the portfolio, the managers would likely sell a portion to bring the asset class back in line with its target. If you're doing the math along with me, that's calculated as 15% plus the results of 15% times 10%. Likewise, if XIC became less than 13.5% of the portfolio, which is calculated as 15% minus 15% times 10%, iShares would likely sell a portion of any overweight ETFs and use the proceeds to buy more XIC. Again, as with BMO, iShares is also more likely to use new cash flows to top up any underweight asset classes, reducing the need to sell existing securities. So now you know about BMO's funds. None of BMO's asset allocation ETFs have fashionable subreddits named after them, like Just Buy ZGRO or Just Buy XGRO, but they are still serious contenders to the iShares and Vanguard one-ticket portfolios. If an asset allocation ETF is right for you to begin with, you really can't go wrong with any of them. I'm Justin Bender of PWL Capital, and if you enjoyed this video, please feel free to subscribe to the Canadian Portfolio Manager YouTube channel. And if you'd like to check out the historical back-tested performance of these asset allocation ETFs, check out the CPM model ETF portfolios available on the Canadian Portfolio Manager blog.